can't say I blame you. It's that kind of market, and we'll talk about that in just a second here. I'm still waiting for Pete and for Wayne, and I thought I had one other one here coming. You, Megan, you probably know who we're still waiting for.
Yeah, I can't remember all of their names, but we had like maybe 10 or 11 besides us. No,
Yeah.
maybe a few less than that.
Why don't we go ahead and get started, and we'll skip around on some of this, but let's start first. John, thanks so much for being here today and kind of helping with this. I know a lot of people are very, very concerned about the money market environment. So talk to us about mortgages right now. What's going on?
Well, I can tell you that the dust is finally starting to settle in some ways and getting kicked up in others. With all of the financial market volatility, we saw a lot of lenders initially pull back and tighten up credit standards, pretty significantly. And then in some areas with government loans, FHA and VA, some of those lending requirements have loosened a little bit. But with Fannie and Freddie on conventional financing, some of that has gotten tighter, and we've seen some programs just completely dry up. The jumbo market is almost non-existent right now.
Oh,
there's still money available out there, but a lot of lenders just aren't wanting to lend in that space. We've also seen some of the alternative credit type programs have dried up and gone away, which would be the stuff that's outside the box, which is really a very small pool of stuff that we see and that the market really has anyway. But anyway, so the lending environment is, we are still lending. We are still closing loans every day. We're still getting people approved. The credit requirements, though, right now are pretty tough, meaning that a lot of lenders have tightened up, and what they're afraid of is if they write a loan for somebody today, and then without having to prove any hardship, they could file for forbearance the next day. And the lenders are pretty freaked out about this, because there's some rules that say if a lender is trying to deliver a loan to one of the agencies, Ginnie Mae, Fannie Mae, or Freddie Mac, and it's first payment default, which would be a forbearance issue, Fannie and Freddie aren't buying those loans. And what that means is that lender is going to be stuck holding that loan, which ties up their warehouse line, and then they have to continue to make the payments whether the homeowner is or not. And so ultimately what that means is credit has gotten tight. So lower FICO scores, we're definitely have a hard time getting those loans completed. Taking cash out of homes right now is a little more difficult, but we're still closing loans. I mean, people are still buying and refinancing every single day.
So what about rates? I mean, where are we at for just the kind of gold standard 20% down, 30-year fixed?
So I'm still seeing on conventional loans interest rates that are in the mid to upper 3% range on conventionals with the vanilla scenario that you've laid out. And on govies, we are down in the low threes still. So, and you might even be able to get less than 3% on a 30-year fix. So we're seeing some very aggressive interest rates right now, some of the best that we've ever seen. But again, the credit requirements are tight. Just to give you an example, the difference between somebody who may have a score of 700 versus 740 could be a quarter point in the rate. Whereas 2 months ago, there was no issue. There was no difference in rate really. So, and the lower the score, the bigger that gap gets.
Interesting.
Yeah.
So Mary, for those of you who have never met her, Mary is our team buyer specialist, and she has been out in the field here the last day or so as they finally allowed us to show. And I was hoping she could just give us a quick kind of overview of kind of what's different between showing now versus showing 2 weeks ago.
Sure. Well, first of all, I've been busier since the virus. So interestingly enough, I've been really fortunate. And I think what I pretty much look at first is what is it that the buyer wants to look for as far as conditions during the virus. I think it's really important that I respect what they need, and if they want to have better sanitation methods in place, then I certainly do that. So I'm fully armed when I go out with gloves and masks, so that it's not me protecting the seller, but it's also everyone that's going into the home. And of course, we're limiting the number of people in the homes. And I think that starting there is the most important part, so that the seller feels good and that the buyer feels good also. I don't really see a lot of change as far as the amount of people that are looking for homes. There's people that need to buy, and we want to take care of them. And so I really appreciate the fact that all of our agencies, like lenders and title companies, have been able to go forward with transactions, because we aren't finding that in other states. During the peak time of the virus, so to speak, I was dealing with a buyer from Pennsylvania, for example, that everything shut down for 2 weeks. And so that causes a lot of challenges for us here, because if they can't sell their home from where they're coming from, then it's very difficult dealing with contingencies. So we've had to work through those. And sometimes I'm putting forward 5 offers to be able to get to that perfect one, because we've got such a low inventory. But, you know, we just keep plugging along and encouraging the buyer that we're going to find the right home, and we're not going to give up on them. We're just going to look to see, you know, and monitor that market and make sure that we're keeping them informed on the conditions, the changing conditions, so that we can get them a home. I mean, that's the most important part, because some people just don't have the option at this time.
Right. You know, when you got to move, you got to move. And I'm guessing it's affecting the pace, just knowing that you have shorter showing windows you have to hit, and you have to make more allowance for notice to the showings. And
yeah, absolutely. And
cleaning.
and we don't want to overextend, and we want to, you know, overlap on these showings. We want to make sure there's enough time between them, so that sellers do have the opportunity if they want to go through and sanitize and that type of thing.
Yeah, yeah. So I think y'all know who I am. I'm Rick, and I'm going to just talk for a couple minutes about kind of general market conditions. And so I guess one of the first things I want to just point out is that we've been about 2 weeks where we were not allowed to physically show houses. So we had to actually show them virtually. We would get lots of good photography. Megan, who is down in my lower left corner, but wave Megan maybe if you want.
Hi.
But Megan has been just absolutely a trooper in terms of hand carving beautiful virtual tours, extended virtual tours of our listings, so that people can see enough to be able to make an offer. And we've actually been putting things under contract that way, subject to them still getting in to see. The little loophole in the rules was, if we were under contract, we could let the buyer in to see the house. And so they write the contract based on the video content, and then they would, and then if we came to terms, then we could go ahead and show them the house, and it was subject to them seeing it. And that's that has worked. We've gotten a number of homes under contract that way, both for buyers and sellers, in the last 2 weeks. Yesterday was the first day of kind of official showings. There were almost 1,000 showings scheduled in the city of Colorado Springs yesterday, or I should say the Pikes Peak MLS. And I think it was 988 or something. I haven't even looked to see what today's was, because I'm assuming that there will be a lot of fluctuation that goes on. I mean, but 1,000 showings on a Monday, hello, that's a lot of activity. So it's very interesting, especially considering we only have about 1,500 active listings currently. So we're still very low inventory. When you kind of parse that down into houses that are physically in El Paso County, that is closer to like a 1 month supply of what we're actually selling at the moment. So, we're right on the edge of about 1,100 homes closing so far in April. We'll probably hit 1,200. Last April, we closed 1,300. So we're not going to see a huge difference in terms of what April looks like. Prices are going to be up. Our median and average price are both up still from last month, and I don't think that's going to change a ton between now and I guess the end of the month is technically Thursday, end of business, so we'll know for sure by then. But it's looking like we're going to have still a pretty strong month. Where it's starting to show up, where the impact it will be, if you will, is going to be in our pendings. In our pending sales right now, we've got fewer than 1,700 pending sales in queue waiting to close. Last year, at the 1st of May, we were at about 2,200. So we're going to see the queue is going to take a little bit of time to fill up, and that's because for about 2 weeks, we've had a very, very difficult environment for trying to fill the queue with pendings. In the meantime, we also have a lot of sellers that are kind of staying home on the sidelines. And why is that? Well, to begin with, we had a lot of sellers staying on the sidelines anyway. We opened the year with very low inventory. It stayed low. We were very low going into this whole crisis, and we're going to be low coming out of it. We are going to be lower than we otherwise would have been because we've got some people that it is honestly not recommended they be on the market at the moment. If you're in your mid 70s and you're thinking about making a downsize move, especially if you got any health issues, I'm recommending to people, frankly, right now, let's not do this right now because they're going to be in a risk category, and we don't want to expose them to people's feet coming in the door and possibly bringing something with them. If they've got no place they can move into temporarily, it's honestly just excessive risk to do that to somebody. At the same time, we've also got people that are really in a very different life situation than they were a month ago. And you mentioned it a little bit, Heidi, with your daughter moving in and your son living with you now. I talked to a client today. He's got 9 people living in his home at the moment. 9. Everybody's house has shrunk at the moment, and it's because they're working from home. Hello, Tracy. You've been doing that for several weeks now. Heidi, you've done it all the time, so we just find you houses that work for that. But for some people that didn't work from home like you do, we didn't find them a home that had that home office for them to do that. So there's shorter room for that. And then they got 2, 3 kids sometimes that are now homeschooling, and all at different grade levels. And so this is a huge problem for some families because they've got 2 home office needs and homeschooling needs for kids that they just didn't have any of that for when they first started. So we're going to actually see, I think, some pressure on housing going forward. People are going to want more rooms. They're going to want bigger homes. But in the meantime, they're not ready to show their house because they're living in chaos at the moment because the dining room table is turned into a homeschool room. The basement workroom is now somebody's office. Even Tony Clement today on a meeting, he was out on his back deck because Brooke was in trying to teach kids, And so this is just a very interesting time. How long is it going to last? That's the tougher part. And I'm going to go back to you, John, because you spend a lot of time looking into the crystal ball, so to speak, at the all the financial data that comes across. So
Right.
What are your experts currently telling you as far as what this whole recovery will end up looking like?
Well, there's no doubt that we're gonna experience a setback, and unemployment rates are expected to top those of the Great Depression and get close to 30%. However, this is not this is a virus problem, not a financial problem. I mean, it's becoming a financial problem also for a lot of people. But what we're kind of expecting is, as people do go back to work and the economy reopens and we get things moving again, it's certainly going to take some time still for some sectors. Certainly the service industry has been the hardest hit, and that's going to be probably one of the slowest parts to come back. But we're seeing, unemployment that'll probably get back to about 7%. And historically, average is about 6. So, so when you look at the long-term unemployment rates of an average of 6%, going to 7%, that's not bad. I think that that's going to, I think that's just testament to the fundamentals of the economy going into this. It was pretty strong in a lot of different areas. Now, how that might trickle into real estate, I honestly believe that that real estate, we might see a little bit of a dip here, but generally most people are in real estate for 7 to 10 years as a primary residence, and I don't think you can go wrong in buying in any market if your time frame is 7 to 10 years. And an unemployment rate coming back down from 30% to 7%, maybe over 6 months to a year time frame. You just look at the birth rates and household formations that are expected to happen over the next 5 years. I really believe that the demand for real estate, especially in that first-time homebuyer market, anything that's within $50,000 of the median, I think that it's going to do very well, in my opinion.
That makes good sense. So we had a bunch of questions that people had come in with, and I'm going to start kind of trying to roll down these, and we'll kind of play ping pong with them a little bit. But the first question here was, will the value of my house as it was March 1 go up or down by July 31? And that's a great question. So I'll take that one because I kind of do our local statistics. So I think we're actually going to continue to see price pressure because the inventory is so tight. And even though we are going to have some buyers that are not going to be able to operate in this market because their jobs have been impacted, we're going to continue to see price pressure. And so, yeah, I think it will be worth more. How much more? That's the harder question. And I'm not going to go out on a limb on that one. I'm just going to leave it with more and kind of go from there. The second question is, if I'm planning to sell next summer, would I be better off refinancing to obtain the lower rates right now, or just stay where I am at 5 1/8 balance around 200,000? John, I'm going to throw that one right back at you.
The key with refinancing, it's all about time. It's all about your costs to refi versus what you're saving. So a sale from a year from now, basically you got to make sure that a refinance is done as a true no cost refinance. And I don't mean just no money out of pocket. I'm meaning if your closing costs are 0 or next to 0 and you're saving on your monthly payment, it could make sense. A lot of lenders don't want to take a loan if they know that the payoff could happen within 6 months to a year, because part of an ongoing problem with the forbearance issue that I talked about a little bit earlier, it takes a servicing company. They actually have to buy the rights to service the loan, whether it's a big bank who's going to service it themselves, or if they're going to transfer servicing to somebody else. There's still a certain cost involved for that loan. And sorry, this is going to be a little, I'm going to make this short. I went a little long-winded here, but the bottom line is that it costs a servicing company a lot of money for the rights to service a loan. And usually it takes them almost 3 years to be profitable when they buy a loan to service. So generally, again, that's why most lenders won't want to do a loan if they know that it's going to pay off within a certain amount of time. But in this case where you might be a year out, you might not. Again, the key is, what's it going to cost you to get the refi done, and how long does it take you to break even in what you're saving on those monthly payments? So I would say it's a toss-up. Probably just have to run the numbers and see what really makes sense. But in general, rates should be significantly lower than that 5% that was quoted in that.
So here's another one for you, John. Considering refis of 2 rental properties, what interest rate would be typical in this COVID-19 space? One of the tenants is having challenges with rent payments projected to be for no more than 2 months, what impact do you think this would be expected to have on the refi application? And then lastly, do you see the market getting busier than sorry, that was the next question. Never mind.
Okay.
Some of these didn't group up right. So yeah, just those two kind of related on the refinancing rental properties.
You know, so as I mentioned earlier, with some of the dust settling and some of it getting kicked up in other areas, anytime you start going outside the box for financing, and this would include non-owner occupied financing, we're not seeing quite as good of interest rates on a non-owner occupied property as we would on a primary residence, because the risk is higher to the bank. If you run into financial trouble, you know, chances are you might let an investment property go before you let your primary residence go. So there are always higher interest rates anyway, but in this environment right now, we're seeing them higher than where they should be, but still decent. You know, I'm seeing interest rates that are in the mid to upper 4% range, you know, with at least 25% equity in the home. As far as a tenant not paying and having any effect on the refinance, it really wouldn't matter. We'd be looking at the prior year P&L, if you will, on that property to determine the income, if it was needed to qualify for the loan for some reason. So what I would say is the dust that's been kicked up in certain areas with the financial world and mortgages, it will settle. And so we are still experiencing some of this pain where it's a liquidity problem that the FHFA needs to solve, and the Treasury is willing to step in, but we need Mark Calabria, who's driving the FHFA, to come along here with some liquidity for the servicing companies in Fannie Mae, Freddie Mac, and anyway, again, not to get down these rabbit holes too far, but what I'm saying is I'm expecting interest rates to remain low for an extended period of time. And what that means is as the dust settles and as we get through this and the economy gets reopened and people get back to work, we see the unemployment levels come back down, lenders are going to feel a lot better about loaning money, which means we should see those types of loans and even the lower credit score types of loans that are a little outside the box, those rates should get better. So timing, you know, I don't see any rush to do something like that right now, because I think that we'll see these rates improve as the dust settles.
Okay. All right, next one. Do you see the market getting busier than we've seen it in the last year? And Mary, I'm going to throw that one to you.
Well, I'm always positive anyway, so I'm trying to be accurate and positive at the same time. But I do see it. I think, and like I said, I've actually been quite busy the last few weeks with people calling, and I anticipate that to increase. And as what I'm seeing, especially with a lot of my leads, is that as we get notification that we're starting to level off with our cases, that I'm getting more activity of people looking for homes and wanting to be set up on MLS and pursuing it a little further. So with that in mind, it seems like there's a trend now to do that. So I think if everybody just follows the rules with social distancing and we can continue to lower that curve, I think it's kind of indicative of the interest that people are having in buying. And I think it's going to continue and it's going to get even more. And I think instead of our typical late spring, early summer rush, we're going to have that later, and it's going to be more into the fall. And I anticipate that it will even peak higher than what we're already seeing.
I would tend to agree with you on all of that. And the next question was how will COVID-19 be affecting sales? And so the other thing that I didn't mention is a dynamic in here that Mary kind of alluded to a little bit, I guess. Maybe she didn't, but John, I guess you talked about demographics and household formation. We got a whole bunch of consenting adults locked into their houses together right now, and I think we're going to see a baby boom out of this. I just just ran into some neighbors yesterday. We were having a conversation, and they were giving me the whole thing with the homeschooling and the home officing and all that stuff, and then said, and oh, by the way, we're pregnant. Yep, right on schedule. You know, it's just how it works. So you know, the other side of this, when we come out, and what we're seeing from some of our own kind of national expert resources, and you know, NAR is pretty good with sharing their information, and we subscribe to a number of services. They're really looking at more of a V-shaped recovery, where this thing is going to kind of drop quick where it has right now, where unemployment has gotten pretty high, but it's going to kind of rebound a little bit quick, and that we are not going to be sitting in the doldrums for very long once we can get people back to work. And you know, that's a big unknown, because we don't control that. You know, there are a lot of people who are ready to go to work right now, and government is telling them they can't. And that's kind of frustrating to some of them. Some of them are actually paying a penalty for that and getting arrested for opening their businesses. I mean, I saw a case in, I guess there's been some cases in Texas already. There was a bar up in Denver that just got busted today, and they boarded the place up because the guy had reopened, and the health people are saying not yet. And he kind of got his hand slapped pretty good for it, I guess. But you know, we're thinking it's going to be a V-shaped recovery, so we're gonna miss part of the year for sure. But by the time we actually get kind of back on track, we're probably going to do more than we were to make up for it. And we'll see some businesses are going to have some catch up that are going to happen from it. You know, people who didn't buy cars because they're not driving and because they're not working, once they get back to work and they realize they're having problems with their car, they're probably going to go back out car shopping. They weren't allowed to for almost a month now. And so I think we're going to see, and Tracy, I hope that's good for your business, because you know, the insurance side of this is kind of a big deal to make sure people are getting insurance both on new cars as well as on new houses. The next question is very specific to a specific client who had sent this in. So I'm going to skip it for the moment. It has to do with kind of what kind of income can be used to qualify. So I'm going to skip that section for the moment and then just jump to this last one here. And that was, how has the Colorado Springs housing market held up during the restrictions? Any guesses for how it will perform in the next 6 to 12? I think I've kind of talked about that enough. I think we've kind of beat that horse a little. So what I'd like to do is now open it up for questions. And so has anybody got some questions they'd like to throw out there that weren't on this list? No questions?
I think you did a pretty complete job.
Laughing.
I think you did a pretty complete job, Rick. I think that covers a lot of ground.
Yeah,
Okay.
you answered my question.
Yeah.
You got yours covered. And I'm sorry, I don't recognize this ZDZIS Law 77. I know this is somebody from our database, but I don't see a name showing up next to it or a picture. You out there? Oh, I got a chat message coming in. Hang on.
B.
Oh, Pete. Oh, okay. All right. I'm sorry. So Pete is okay. I think I had a different. I think I had a different email for him. Okay, so
email.
Pete, since you're there, then we are going to cover your question here a little bit. And John, maybe you have this question. It's kind of long, so I was thinking maybe you could kind of look at it a little bit. But it's basically dealing with disability income that is not W-2 or 1099 related, and how does that all work in terms of ratios, what can count, and the whole bit.
Right. Well, disability income is certainly acceptable for underwriting to be approved for a loan. The key is, if it's long-term disability, we just have to have the terms, to show what that is. And actually, if it's short-term disability, also the same rules would apply. Generally, for any underwriting, when we look at income, we always the underwriting is always looking back 2 years to see the history, and then they try to look forward 3 years to, is it reasonable to expect that that income is going to continue? So in this case, where it's if it's long-term disability, then it should, I'm guessing it's going to be a permanent thing, or at least as long as it lasts for 3 years, that can absolutely be used for qualifications to purchase a home. So I think that was the main questions surrounding, or the main issues surrounding that question.
Yeah, if you look at the chat stream, can you pull that up on yours? He's saying that it's long-term disability. There's no 1099 or W-2, and there is he's looking out 3 years on this in terms of what are the repercussions for that in terms of how it's going to affect qualifying.
Yeah. I think I'd seen the chat here. So yeah, so again, it's as long as it's going to continue 3 years to the closing date. So if you're closing tomorrow and it's going to expire 3 years post the closing date, even if it's 1 day, it's fine. If it expires the day before, it wouldn't be eligible to be used for qualifying income.
Okay, so like employment income, you like to see that it's going to continue 6 to 12 months or whatever. I mean, it's a shorter period, but for this type of income, it has to be something that it's going to go longer.
Right.
Yeah. Okay. All right. That makes sense.
And the question is, same rates and closing costs as a regular loan? Absolutely. So it's the thing about qualifying for a loan is it's not discriminatory about how your income is received or generated or earned. So income is income. If you qualify, you qualify. And then you have the credit qualifications. And then of course, the down payment piece, your investment into the loan and purchase. So you get the same access to rates and programs, whether it's regular W-2 income, long-term disability income, commission income. It's just a matter of how that income is calculated.
Okay. Pete, do you have any other questions related to that you want to bring in either to the chat or otherwise? All right. Well, thank you all for joining us today. This is an experiment a little bit, so you've been our guinea pigs and you all did great. Nobody asked any really bad questions, so that was good. Or even questions like, is John wearing shorts or is he wearing khakis? I mean, we'll never know. It was a nice day here. I had to give him that little bit of a jab, but
I did ride my bike to work this morning, and I'm going to attempt to ride it home. So I'm wearing shorts.
Okay, Beth, make sure he takes a shower after he gets to the top of the hill at your house, because oh my gosh, I would never ride a bike up that hill. That's crazy. But anyway, I just appreciate y'all joining us, and we'll try to do some additional things like this, I think, in the future. But just really appreciate it. I did record this, so if you would like a link to the recording, if you had somebody that you wanted to have hear it, Tracy, I think you had mentioned Andy might be interested. We'll send you that.
Okay.
And same for you, Heidi, if you needed any of it, or Jim, or anybody else that would like it. Otherwise, we'll have that, and then we'll figure out what to do with it. And maybe we won't do anything with it, but I'll make sure that you get it at least, Tracy.
And
That's
Rick,
awesome. Thank you.
Rick, I'm guessing if somebody has specific questions for you or Mary, I know for myself, I'm happy to do conversations offline. So, if you've got another more specific question about a scenario or anything else, I'm sure you guys are happy to help.
Great. Appreciate that a lot, John. Thank you so much for being willing to do this tonight. Everybody have a wonderful evening.
Thanks for doing this.
Thank you.
Appreciate it.
Bye.
Well,
Stay
Bye now.
healthy. Bye-bye.
Talk
Thank
to you later.